We're told the stock market is the engine of prosperity, the bedrock of our economy, the path to a secure retirement. But what if it's none of those things for most of us? What if, instead, it's a system designed to benefit a select few? A casino where the odds are stacked, and a force that actively harms the average American. Today, I'm not just going to question the stock market, I'm going to explore why it might be time to consider shutting it down. Let's start with who actually owns the stock market. Is it everyday people diligently investing their savings? The reality is a stark picture of inequality. The wealthiest 10% of Americans own a staggering 93% of all U.S. stocks. Additionally, according to recent data, the top 1% of households own 50% of corporate equities, while the bottom 50% hold just 1%. This concentration means that stock market gains primarily enrich the already wealthy, leaving most Americans with minimal benefits. For many, participation is limited or non-existent, as lower income groups are less likely to invest due to financial constraints. The next thing I want to address is high frequency trading and the market instability that it causes. High frequency trading, or HFT for short, can create ghost liquidity, orders that appear and vanish in milliseconds, making it impossible for ordinary investors to act on. They don't invest, they skim. However, this practice can destabilize markets. The 2010 flash crash, where the Dow Jones plummeted nearly 1,000 points in minutes, was exacerbated by HFTs, highlighting its potential to create volatility and disadvantage regular investors. HFT gives an unfair advantage to firms with significant technological resources, undermining market fairness. And how about the disconnect in stock valuations from the fundamentals of the companies? Stock prices often diverge from the actual performance of companies, driven by speculation rather than fundamentals. We see companies with little to no profit or even significant losses with skyrocketing stock prices driven by hype and speculation rather than fundamentals. Historical bubbles like the dot-com bubble of the late 1990s saw stock prices soar beyond reasonable valuations only to crash and erase billions in wealth. Such disconnects mislead investors and destabilize the economy when the bubbles burst. And I've had a long-held belief that the stock market is nothing more than a casino. For many, particularly day traders, the stock market resembles gambling. Research indicates that only 1% of day traders are profitable after 5 years, with 72% experiencing losses annually. This high-risk environment, driven by short-term speculation, leaves many retail investors vulnerable to significant financial losses. In fact, legendary investor Warren Buffett himself has warned that the market increasingly resembles gambling. And can you even tell me what the original purpose of the stock market was? Originally, stock markets were designed to raise capital for companies through initial public offerings, or IPOs. Today, secondary market trading dominates, with little direct benefit to the companies. In 2024, the U.S. IPO proceeds totaled $33 billion, a tiny fraction compared to the hundreds of billions of dollars traded daily. This shift prioritizes investor profits over business funding. Additionally, by the time most companies IPO, they no longer need capital, as they more frequently attain the required funding for growth through rounds of funding and venture capitalists, but instead are used by the founders to cash out and make large sums of money. And how about the elite influencing government policy based on their ability to move the stock market? The stock market isn't just a financial mechanism. It's a tool of power, wielded by elite interests to their advantage, often at the expense of everyone else. The threat of a tanking stock market is often used by elite interests to sway public policy. Fear of economic fallout, which, as we've seen, disproportionately affects the wealthy's paper assets but can trigger broader panic, can push governments into decisions that favor the corporations and the rich rather than the public good. The stock market's volatility can also pressure governments to enact policies favoring wealthy investors. During the 2008 financial crisis, massive bailouts were implemented to stabilize markets, often prioritizing corporate interests over public welfare. Such actions suggest that elite interests can leverage market dynamics to influence policy, sidelining the needs of average Americans. And what about the economic risks from all this speculation? Speculative bubbles in the stock market can trigger severe economic crises. The 1929 crash, fueled by rampant speculation, led to the Great Depression, with unemployment soaring to 25%. Similarly, the 2008 crisis, partially driven by speculative excesses, caused widespread economic hardship, demonstrating the market's potential to destabilize the broader economy. These weren't just numbers changing on a screen. They led to mass unemployment, poverty, and widespread suffering. And something that I think is a huge issue is that your retirement is vulnerable. Perhaps one of the cruelest ironies is how the financial security of millions, their retirement, has been shackled to this volatile and inequitable system. And the speculative nature of the market has a history of bringing entire economies to their knees. Many Americans rely on the stock market for retirement through plans like 401ks, which can be risky. In 2008, market losses cut retirement savings significantly, forcing some to delay retirement or cut back on living expenses. This vulnerability can leave people financially insecure. Inflation also adds another layer of stress. If your portfolio is already strained, as rising prices can further erode your purchasing power. And my least favorite topic, stock buybacks. Companies often use profits to buy back their own shares, which can boost stock prices, but may not help the business grow or benefit workers. In 2022, U.S. companies spent over $1 trillion on buybacks, often more than they invested in innovation or wages. This focus on short-term gains can hurt the broader economy. And I've made a video that's dived in very deeply to this, but it's also used as tax avoidance by the wealthy. The wealthy utilize the stock market for sophisticated tax evasion, or more commonly, legal tax avoidance strategies, unavailable to the common person. Capital gains from stocks are often taxed at lower rates than wages. Complex trusts and borrowing against assets allow the rich to access wealth without triggering taxable events. The wealthy can also use the stock market to avoid taxes through strategies like buy, borrow, die. They hold their stocks to avoid selling and paying taxes, borrow against them for cash, and pass them to their heirs tax-free. This reduces government funds for public services and widens inequality. The picture that emerges is deeply troubling. A stock market that exacerbates inequality, operates like a rigged casino, is detached from real value and its original purpose, serves as a tool for elite interests, and jeopardizes our retirement and can devastate our economy. So why should the stock market be shut down? Because in its current form, it largely fails the average American. It has become a mechanism for wealth extraction by a tiny minority prioritizing speculative profits over productive investment, human well-being, and economic stability. Of course, the idea of shutting down the stock market is radical. The counter-arguments will be loud and plentiful, focusing on its role in capital allocation and economic growth. But we must ask, growth for whom and at what cost? Perhaps it's time to imagine a different system, one where capital is raised for enterprises in a more direct, transparent, and socially beneficial way, where people's savings aren't exposed to the whims of speculators, where the economy serves the many, not the few. Challenging the status quo is never easy, but the first step is to see the system for what it truly is. And for too many, the stock market is a rigged game that they are forced to play, with rules they didn't write and where the house almost always wins. If you found this video informative, please hit that thumbs up down there. That really helps me out. If you have any thoughts on this topic, or if you want me to cover any one of these points in depth, I truly think any single one of these can be an entire standalone video by itself. Drop that in the comment which one you would like to see. But other than that, if you've made it this far, thank you for watching, and I'll see you in the next one.